The financial system is built to keep you working. The financial system of today is often portrayed as a landscape of opportunity, freedom, and upward mobility. Advertisements promise independence, banks offer credit lines, and financial planners sell visions of wealth accumulation. Yet beneath this facade lies a structure that subtly encourages continuous labor, long hours, and persistent financial engagement. For many people, the economy does not simply reward effort. It keeps individuals tied to work, often in ways that limit long-term autonomy and wealth accumulation. Understanding how the system is designed and how daily financial structures influence life choices is key to navigating modern economic life. This is not a story of conspiracy, but of design. Incentives, regulations, and cultural expectations have evolved in ways that normalize constant work, recurring debt, and ongoing financial obligations. While individuals may achieve temporary wins, the broader structure ensures that effort is rarely fully liberated from obligation. From student loans to mortgages, credit card systems to everyday living costs, the architecture of modern finance keeps households engaged in a cycle of labor, repayment, and deferred freedom. This script explores the mechanisms behind that cycle and why it is increasingly difficult to achieve true economic independence. The illusion of economic freedom. Economic freedom is often advertised as the ability to make choices, control your income, and pursue personal goals without restriction. In reality, much of what passes for freedom in the modern economy is structured around obligations, conditional access, and ongoing dependency. People may feel empowered by their paychecks or investments, but the bulk of income is typically committed to immediate expenses, rent or mortgage, utilities, debt repayments, and everyday necessities. True discretionary income, the portion that can be used for wealth building, investment, or personal growth, is often far smaller than it appears. This illusion is reinforced culturally and psychologically. Social media, advertising, and lifestyle trends create pressure to spend, invest, and appear economically successful, even if the underlying financial reality is fragile. Individuals may feel they are exercising choice when buying luxury goods, upgrading technology, or subscribing to services, and yet these expenditures often mask the fact that savings, investments, and true financial freedom are limited. The system encourages movement, engagement, and consumption, activities that keep money flowing back into the economy but rarely build long-term independence for the individual. Moreover, the structures of employment and taxation contribute to this perception. Wages, benefits, and job stability may give the sense of progress, but actual accumulation of wealth and autonomy is slow and heavily dependent on external factors. This means that even diligent effort can feel like running in place, working harder, earning more, yet staying tethered to the obligations the system has created. Recognizing the difference between perceived and actual economic freedom is critical for anyone seeking to break cycles of dependency. Financial literacy alone does not completely solve this. While understanding debt, interest rates, and investment strategies can improve outcomes, the underlying system is still structured around participation, continuous work, recurring payments, and engagement in consumption. The illusion of freedom works precisely because it gives the appearance of choice, while maintaining structural constraints that keep households reliant on labor. Ultimately, the illusion of economic freedom demonstrates how systems, incentives, and expectations align to maintain engagement with work and money. True independence requires not only effort but strategy, awareness, and deliberate financial choices to reclaim control from structures designed to keep individuals tethered. Payday to payday living. For many households, some financial life revolves around cycles of receiving income and immediately allocating it to essential expenses. This payday-to-payday existence is more than a temporary challenge. It has become a structural condition for millions, when nearly every paycheck is absorbed by rent, utilities, groceries, and recurring obligations. Opportunities for wealth accumulation, investment, or savings become minimal. The system effectively channels effort toward maintenance of daily survival rather than long-term progress. Living paycheck to paycheck has psychological and behavioral consequences. Households experience constant pressure, stress, and a sense of financial fragility that shapes every decision. Emergencies, unexpected bills, or minor fluctuations in expenses can trigger disruptions that ripple across weeks or months. In this way, even disciplined spending and careful budgeting are often insufficient to break the cycle without structural shifts in income, expenses, or debt obligations. The phenomenon is self-reinforcing. When households anticipate high monthly obligations, they may prioritize short-term liquidity over longer-term investment. Savings accounts, retirement planning, and investment vehicles become secondary to immediate survival. Even when wages increase, lifestyle inflation or rising costs often absorb gains, maintaining the cycle of dependence on regular paychecks. Cultural and systemic factors amplify this cycle. Employers often structure work to require consistent engagement, while financial institutions incentivize recurring spending through credit, subscriptions, and loans. Individuals may feel trapped, not because of personal failure, but because the structures around them favor continuous labor and limited accumulation. Breaking the cycle requires both strategic awareness and systemic adaptation. Households must identify ways to increase discretionary income, reduce obligations, and redirect resources toward long-term growth. Awareness of how the cycle operates is the first step toward reclaiming financial autonomy and moving beyond the constraints of payday-to-payday living. Credit cards and debt cycles. Credit cards are often marketed as tools for convenience, rewards, and financial empowerment, yet they are central to modern debt cycles that keep individuals tethered to continuous work. The system incentivizes spending now, paying later, and relying on recurring interest payments to maintain liquidity. While small balances may be manageable, our interest accrues quickly for most households, creating a cycle where repayment consumes a growing portion of income. Debt cycles extend beyond credit cards to include store financing, personal loans, and revolving credit, all designed to maintain ongoing engagement with money. For the middle class, these cycles are often invisible at first. Low minimum payments, deferred interest, and rewards programs encourage continued participation. Over time, the burden of repayment reduces available income for wealth accumulation, forcing households to work harder to cover routine obligations while interest continues to compound. Credit dependency has broader consequences for financial behavior. It creates a psychological association between consumption and necessity, normalizes ongoing debt, and shifts priorities away from saving, investing, or building equity. Individuals may feel temporarily empowered, but the structure of credit ensures that many remain tied to labor to service these obligations. Even financially literate households face challenges because credit cycles exploit predictable human behavior, the temptation to spend, the pressure to maintain appearances, and the need to respond to emergencies quickly. The systems are designed not to prevent debt, but to ensure participation and sustained engagement with financial institutions. Breaking free from these cycles requires discipline, strategic planning, and an understanding of how credit is structured to extract ongoing labor and income. Awareness of the mechanisms behind debt can help households regain autonomy and redirect effort toward long-term financial goals rather than immediate consumption and interest payments. Student loans. As a lifetime burden, education is often framed as the pathway to upward mobility, yet student loans frequently function as long-term financial chains. For many graduates, repayment obligations extend decades, significantly reducing the capacity to accumulate wealth, invest, or purchase property. The promise of higher earnings and increased opportunity is tempered by the reality of sustained debt, which can influence career decisions, housing choices, and lifestyle planning for years after graduation. The psychological weight of student loans is significant. See, graduates face the tension between ambition and obligation. Pursuing desired careers may be limited by repayment requirements, while lifestyle and family planning decisions are delayed or constrained. Even with good salaries, a substantial portion of income may be dedicated to debt service, creating a sense of financial bondage despite steady employment. Student loan debt also has compounding effects on wealth accumulation. The delay in purchasing a home, investing in retirement, or building an emergency fund can ripple across decades, leaving households with less time to leverage compound interest and property appreciation. Generational impacts are notable as well. as the ability to transfer wealth or assets to the next generation is diminished. The structure of the student loan system reinforces the cycle of labor. Us graduates must maintain steady employment not simply for survival but to meet repayment obligations, ensuring continuous engagement with the workforce. The system ties educational achievement directly to long-term work commitments, creating structural dependence on employment to service debt. While strategic repayment plans, refinancing, or income-based programs can help, student loans remain a persistent example of how financial structures are designed to keep households working. The impact is both economic and psychological, influencing life decisions in ways that often extend far beyond the initial purpose of education. Mortgage systems that trap homeowners. Homeownership has long been celebrated as the ultimate financial goal, yet mortgage systems often create long-term obligations that tie households to work for decades, or monthly payments, interest, property taxes, and maintenance costs require steady income, often locking families into employment to service debt. The structure of mortgage financing ensures that even high earners must dedicate significant portions of income toward obligations that may outlast the initial excitement of home ownership. Interest structures amplify this effect. Early payments primarily cover interest rather than principal, delaying equity accumulation and keeping homeowners financially tethered for many years. Rising property taxes, variable rates, and additional fees further complicate financial planning, creating a system where labor is continuously required to maintain ownership rather than building immediate wealth. The mortgage system also influences life choices in subtle ways. Job location, career changes, and family planning are often constrained by the need to maintain consistent mortgage payments. Financial flexibility diminishes, and households may prioritize stability over opportunity to ensure obligations are met. Even minor economic shocks, a rate increase, job loss, or unexpected expense, can disrupt planning, highlighting the structural dependence on continuous work. Homeownership as a long-term wealth-building strategy remains valid, but the pathway is narrow and requires careful navigation. Mortgages create both opportunity and constraint, illustrating how financial systems offer the illusion of freedom while ensuring ongoing engagement with labor. Ultimately, mortgage systems exemplify how the architecture of modern finance binds effort to obligation. Say the dream of owning a home comes with structural conditions that ensure households remain tethered to work, often for decades, highlighting the broader reality that financial independence requires awareness, planning, and strategic decision-making. The role of inflation in wealth erosion. Inflation is one of the most subtle yet powerful forces keeping people tethered to work. While paychecks may increase nominally, rising prices for essentials such as food, energy, healthcare, and housing quietly erode the purchasing power of each dollar earned. Middle-class households often find themselves working longer hours to maintain the same standard of living they once enjoyed, creating a cycle where labor seems never-ending and financial progress elusive. The effects of inflation are slow, almost imperceptible, but over decades they can drastically reduce the ability to accumulate wealth and secure long-term stability. The invisible nature of inflation amplifies its impact. Unlike a sudden expense, which prompts immediate adjustment, inflation works incrementally, often going unnoticed until savings, investments, or discretionary income begins shrinking in real terms. Even careful budgeting cannot fully compensate for the compounding effect of inflation over time, forcing households to adapt continually, delaying long-term financial goals, and reinforcing dependency on consistent work to bridge the gap. Inflation also interacts with other financial structures in ways that intensify its impact. Interest on debt, rent increases, and variable costs of goods all rise alongside inflation, making the cost of servicing obligations higher while the real value of wages often lags behind. This creates a scenario where financial freedom is perpetually postponed, even for disciplined earners who meticulously plan their budgets. Beyond its financial impact, inflation has psychological consequences. Individuals and families may feel trapped, working harder but never advancing in wealth or comfort. The slow erosion of purchasing power instills a sense of urgency and compulsion to maintain employment, as stepping away from labor, even temporarily, can quickly diminish financial security. Despite these pressures, understanding inflation and its systemic role is crucial for planning. Investment strategies, diversified income streams, and forward-looking budgeting can mitigate its effects. But households must recognize that inflation ensures continued engagement with labor and financial activity, subtly maintaining the system's structure. Inflation, therefore, is not just a macroeconomic phenomenon. It is a mechanism that shapes daily life, binds effort to necessity, and gradually erodes wealth unless countered by strategic planning and awareness. Retirement systems that depend on work. Retirement systems in many countries are structured around continuous labor and long-term participation in the workforce. Social security, pensions, and employer-based retirement contributions are often tied directly to years of employment, creating an environment where financial independence is conditional on decades of sustained work. While the promise of retirement exists, access is rarely immediate, and benefits are frequently insufficient without substantial personal contribution and ongoing income. The reliance on work for retirement security creates structural dependence. Individuals must maintain consistent employment not just to survive today, but to ensure stability decades into the future. Interruptions in income, through career changes, layoffs, or health issues, can disrupt retirement planning, delaying the ability to accumulate assets and compounding the pressure to remain continuously employed. The system rewards longevity and stability in labor, while penalizing gaps or periods of inactivity. Employer-based retirement systems also emphasize contributions rather than immediate wealth creation. Matched contributions, vesting schedules, and tax advantages are tied to employment rather than independent investment strategies, subtly incentivizing continuous labor. While these programs appear to offer security, they often ensure that work remains the central path to long-term financial stability rather than offering truly independent means of accumulation. Additionally, the modern workforce faces increasing uncertainty in retirement systems. Shifting policies, market fluctuations, and demographic pressures threaten the stability of pensions and social safety nets, further reinforcing the need for sustained labor. Workers are forced to hedge risks through extended work life, additional income streams, and careful financial planning, binding their present labor to future security. The psychological and cultural dimensions are notable as well. The expectation of a stable retirement creates life plans, career decisions, and spending habits that prioritize long-term work engagement. The system shapes not only economic behavior, but the broader narrative of adulthood, tying identity and life structure to continuous participation in the labor market. Ultimately, retirement systems demonstrate how financial frameworks are designed to ensure ongoing labor. While they promise security in the future, the mechanisms for accessing that security tie households to work in ways that maintain systemic control and participation. Tax structures. Favoring the wealthy. Tax structures are often presented as neutral mechanisms for funding public services, but they also have profound implications for who accumulates wealth and who remains tethered to labor. Progressive taxation exists on paper, but loopholes, deductions, and capital gains advantages disproportionately benefit the wealthy, allowing asset holders to accumulate wealth at a faster rate than wage earners. Meanwhile, middle-class households are left dependent on income from labor rather than investment to maintain financial security. These structures amplify systemic dependence on work. For many, labor is the primary source of income that can be taxed predictably, while assets held by the wealthy grow with minimal interference. This creates a dynamic where continuous work is not simply necessary for survival, but essential for maintaining parity with rising costs, debt obligations, and long-term goals such as housing, education, and retirement. The disparity is reinforced by complexity. Understanding tax law, capital gains treatment, and allowable deductions requires resources and expertise that many households cannot access. The middle class often faces the brunt of standard income taxation, while higher earners leverage financial instruments to reduce exposure, further widening the gap between those who rely on labor and those whose wealth generates more wealth passively. Additionally, The interaction of taxes with credit, mortgages, and retirement systems creates a layered effect. Households must navigate obligations across multiple domains, often dedicating income to cover tax liabilities, servicing debt, and managing living costs simultaneously. The cumulative effect ensures that labor remains central, while asset-driven wealth continues to grow at a disproportionate rate. Awareness of these dynamics is crucial. While tax policy is difficult to change individually, understanding its structure helps households plan more effectively, identify opportunities for advantage, and appreciate how systemic design incentivizes continuous work rather than independent wealth accumulation. The structure of taxation, therefore, is not neutral. It is a mechanism that reinforces the centrality of labor for the majority, while allowing wealth concentration for those with assets and strategic knowledge. The gig economy's hidden costs. The gig economy is often marketed as flexible, empowering, and a pathway to supplemental income. On the surface, it offers freedom from traditional employment structures, allowing workers to choose hours, projects, and clients. Yet beneath this surface lies a system that imposes hidden costs, subtly tethering workers to continuous effort while reducing benefits, stability, and long-term security. Gig work lacks traditional protections such as paid leave, healthcare contributions, retirement contributions, and job stability. Workers must continuously earn to cover basic living expenses, effectively creating a cycle where the appearance of flexibility masks an underlying dependence on ongoing labor. Income can fluctuate unpredictably, making budgeting and planning more complex while reinforcing the need to maintain constant engagement. Additionally, the gig economy often shifts responsibility for expenses and investment onto workers. Health insurance, retirement planning, equipment, transportation, and self-employment taxes are all absorbed individually rather than pooled through an employer. While this structure offers nominal independence, it requires continuous labor to cover both personal and professional costs that traditional employment might otherwise share. The psychological effects mirror financial realities. Gig workers often experience uncertainty, pressure to maximize hours, and the stress of managing variable income. The system encourages engagement, responsiveness, and adaptability, ensuring that work remains a central and constant part of daily life even when the appearance of freedom exists. Ultimately, the gig economy demonstrates how modern financial systems create a perception of flexibility while structurally ensuring dependence on continuous labor. The promise of autonomy exists, but the hidden costs tether workers to persistent effort, reinforcing broader patterns in the economic system. Now, corporate dependence on employee labor corporations are designed to generate profit through continuous engagement of human labor, and much of the financial system reinforces this dependence. Wages, benefits, productivity metrics, and incentive structures are engineered to ensure employees remain motivated, engaged, and tethered to organizational goals. For middle-class households, this translates into a structural reality where financial independence is dependent not only on personal performance but on sustained participation in corporate structures. The systems supporting corporate labor are multi-layered. Retirement contributions, health benefits, and career advancement are tied directly to continued engagement, ensuring that households maintain labor commitments for long-term security. Promotions, raises, and bonuses are contingent on sustained effort, creating a direct correlation between work and survival or prosperity. Corporate dependence also shapes life decisions beyond the workplace. Job location, family planning, housing, and education choices are often influenced by corporate structures and demands. The predictability of corporate income comes with implicit constraints, making autonomy conditional on participation. The architecture of employment ensures that work remains central to financial stability and life planning. Moreover, corporate labor structures interact with other systemic mechanisms, such as debt, mortgages, and inflation to reinforce dependence. The interplay of these systems keeps households continuously engaged, demonstrating how financial design, labor expectations, and economic incentives converge to maintain participation in the workforce. Understanding corporate dependence highlights how economic structures channel human effort in predictable ways. While corporations provide stability, opportunity, and income, they also create systemic mechanisms that ensure labor remains the central vehicle for financial survival, reinforcing the broader cycle of engagement that defines modern middle-class life. If this video gave insight into how the financial system shapes work and life, share your thoughts in the comments below. Like the video if it helped you see the hidden structures behind modern labor and income. Subscribe to the channel to stay updated with in-depth breakdowns of economic realities that affect everyone. Share this video with friends and family navigating the pressures of work, debt, and financial systems.